So this is part 5, dissecting the Nigerian Tax Act 2025 for clearer understanding. So we brought you part 1, part 2, part 3, and part 4. So we will be continuing with part 5 in this video. So we'll be sharing the screen quickly. So this is part 5. We'll be dissecting everything for you in this video, because 2020 corner and we must be ready ahead in 2026. So in today's video, we'll be bringing you taxable profit of non-resident. Taxable profit of non-resident company. So when you hear of non-resident company, what it means is that they are company that does not have permanent establishment in Nigeria, like physical office in Nigeria. So they are non-resident company. They are not resident, from the name non-resident company. They are not resident in Nigeria. But some of them are just deriving income, maybe through digital means, maybe through one project or the other, and some other means of generating income in Nigeria. So, but regardless of any means that they are using to generate income, they are still subjected to tax in Nigeria, depending on the kind of projects or operations they are carrying out in Nigeria. So you can see from the screen we are sharing with you now. So taxable profit of non-resident. So the Nigerian Tax Act, which is called NTA, expand the scope of the activities of non-resident companies that are subject to tax in Nigeria. So the scope of their work, their operations, their activities, what they are doing that are subjected to tax, that will be used to tax the non-resident company. Notably, the NTA introduces force of attraction. So that is the phrase, force of attraction rules. Under these rules, certain activities carried out by a non-resident company or its related parties can be taxed as part of the non-resident company's permanent establishment in Nigeria. So any of the activity or any part of the non-resident company, because some of them have subsidiary and some other arms, associates, and maybe partnership, all of those things. So anything at all that is part of the non-resident companies, so will be subject to tax, provided that is within the scope of the NTA. Even if the activities are not physically conducted through the permanent establishment. So if the activities are not physically conducted through permanent establishment, in addition, profit from engineering, that's where the scope now comes in, where they will be taxed. Engineering, procurement, construction contracts can be taxed in Nigeria. So I call this one EPC, engineering, procurement, and construction. So anything within this scope will be definitely taxed, even if some of the activities are performed under a separate contract or outside Nigeria. So any scope within these activities or operations will definitely be taxed by the Nigerian Tax Act for non-resident company. So we move ahead to minimum tax for non-resident company. So when we talk about minimum tax, the list of tax that the non-resident companies can pay. So we'll be looking at it. So non-resident companies who have a taxable presence in Nigeria will now be subject to minimum tax based on the percentage of their earnings before interest and tax. So that's EBIT, EBITDA, something like that, EBIT. So earnings before interest and tax. So any earnings that they have before this earning before interest and tax will be subjected to generated from Nigeria. So it will be taxed on earning before interest and tax. In any case, tax payable by such companies, that's for non-residents, cannot be less than the withholding tax. So that's the minimum tax, withholding tax. So this withholding tax is a tax at source, which we have explained to you earlier on. We have video on the withholding tax. So the withholding tax rate applicable to the income or 5% of the income. So it's either of the two. Also, in section 5I of subsection 8 of Nigerian Tax Administrative Act 2025. So we can see that the expenses in foreign currency are deductible only at the official CBN exchange rate. So any deductible expenses in foreign currency will be converted to the CBN exchange rate and will be deducted to arrive at their taxable income for non-resident company. Then use of earnings before interest and tax from financial statements for profit determination or even from comparable companies. So if it is not available, they will look at a comparable head. Controlled foreign company rules. Controlled foreign company rules. So companies that are not Nigerian based, but they are foreign companies and are operating or carrying out one activity or the other to generate income in Nigeria. So the Nigerian tax act imposes a tax on undistributed profits of foreign companies controlled by Nigerian companies. So you can see that now, where it is considered that the foreign subsidiary could have distributed dividends without harming its business. Introduction of controlled foreign corporations, that's CFC, rules is to counter profit shifting. There are so many profit shifting which are being concealed from being taxed. So this is part of it. The objective of that's controlled foreign corporation, that's CFC, rules is to prevent such tax deferral by extending the residence tax rules to the income of the foreign subsidiary companies. A CFC rules require that the undistributed income of the foreign subsidiary company is attributed to the resident shareholder and taxed as if the profit had been distributed. So you can see this in section 6 subsection 2 of the Nigerian Tax Act. Then quickly we'll move to development levy. So section 59 of NTA imposes development levy. Imposes development levy is imposed on accessible profit of companies. So what we have here before is the accessible profit, right, will be, determined in the education tax. Is from the Education Act tax that will get this accessible profit. So when company compute their tax, that's in their audited account. So if they get accessible profits, so 3% is usually charged as tertiary education tax. But now the development levy has been introduced in place of that. So it will now be 4% on accessible profit as development levy. So 4% development levy is introduced to be allocated to key government agencies as follows. So these are the 4% that will be charged as accessible profit from companies will be distributed or allocated. The first one, tertiary education trust fund, that's state fund, 50%. That's what they will collect from the 4%. Fund, we know of NEL fund that students, so they can get loan to finance their educations instead of many people not having money to enter school, and then their dreams of becoming what they want to become is shattered. So the federal government have introduced the NEL fund. So 15% will go into NEL fund. Then National Information Technology Development Agency, that's NICDA, we have 10%. National Agency for Science and Engineering Infrastructure, that's NASENI, will have 10%. Then National Cyber Security Fund, we have 5%. Then Defense Security Fund, we have 10%. So if we add up all the percentage, you will see that it adds up to 100%. So that's how the development levy of 4% on the accessible profit of companies will be allocated. So currently what we are practicing is, like I said earlier on, education tax is usually 3% of adjusted profit or accessible profit as well. Then we have NICDA, 1% of profit before tax. That's what we charge, that is being charged in this current tax that we are using. Then NASENI is 0.25% of profit before tax. Then police levy is 0.005% of profit before tax. So if you add up all these together, right, you can see that it's still in a bit more than 4%. So 4% have been introduced as flat rates on all these NICDA 1%, education tax 3%, NASENI 0.25%, police levy of 0.005%. Non-inclusion of police levy in the development levy signifies the abolition of police levy. So you can see from the breakdown that we don't have police. Police does not have any distribution or they are in the allocation of the development levy. So that means the police levy has been abolished or removed totally. It is expected that the federal government will set up Development Levy Allocation Committee, DLAC, that will be meeting monthly for the allocation of development levy, where representatives of TED Fund, NICDA, NASENI, NEL Fund, Office of the National Security Advisor, Ministry of Defense, and the Office of the Accountant General of the Federation, where development levy will be allocated in line with the provision of the Act. So this is what will be happening to the development levy allocation from all the key agencies. Then we move by personal income tax. Personal income tax, that's the PIT. So the introduction of rent relief, the NTA eliminates the consolidated relief allowance, that's CRA, and introduces a rent relief in section 30 subsection 2(6) of the Act. So for individual taxpayer, instead of having consolidated relief that we used to have in this current tax that we are using, it has been replaced by rent relief of 20% of annual rent or a maximum of 500,000, either of the two, whichever one is lower or greater, depending on the rent of the taxpayer. So which is 20% of annual rent, like I said, subject to a maximum of 500,000. So you can only have 20% or a maximum of 500,000. So you cannot have a rent relief of above 500,000. It can only be 20% or 500,000. So if you compute 20%, if it is greater than 500,000, you can only take 500,000 as maximum. So whichever one is lower is actually the one that is lower. However, to claim this relief, declaration must be made regarding the actual rent paid and the tax authority has the right to request additional relevant information. So this is where your documents information is very important in keeping it, so that anything that will need to be verified, you can present it for verification to claim your relief. The takeaway from this is that individuals that live in their own accommodation cannot claim such relief. So you can see now, if you are living in your own accommodation, sorry, you cannot get this relief allowance. This begs the question of why the CRA has not been retained. So this is a question that is still begging for answer, that why will they remove the consolidated relief allowance and replace it with rent relief if the owner of an accommodation cannot still get the rent relief? To move forward, this is personal income tax rates after relief has been granted. So once the relief of the 20% of rent or 500,000, whichever one is lower, has been granted, then we now have this graduated tax rate. The first 800,000, this is actually annually. It's annual tax deduction. So the first 800,000 is 0%. You will not pay. So if you are earning below minimum wage, right? If you multiply 70 times 12, so you can see it still fall within this 800,000 or maybe little above, depending. But minimum wage is exempted from tax. And if your total income in a year is 800,000, it's exempted. Then the next one is 2.2 million, is at 15%. Then the next 9 million is 18%. The next 13 million is 21%. The next 25 million is 23%. And above 50 million is 25%. So what we should note from this graduated tax rate in this NT is that chargeable gains shall be taxed as income tax. Chargeable gain, that's CGT, that's more like capital gain tax, will be charged as income tax by the taxpayer. So currently, if a man makes gains of 100 million from disposable of his property, that's capital gain tax, such gain will be charged under capital gain tax, of which 10% will be applied on the gains. That's what we used to have before. So if you have removed all your costs, all your expenses from the capital assets that you have sold, so the profit will now be charged at 10%. That's what we used to have. But now it will now be computed based on this personal income tax graduated rates that we are seeing in this presentation. In the new law, tax rates which ranges from 0 to 15 to 25 will apply on the 100 million gains. So that's what we'll be having on the capital gain tax from next year, 2026, 1st of January. So requirement for employees to file returns. So for all employees, these are the requirements to file returns. In addition to the existing obligations for employers to remit income taxes and file returns under the pay as you earn, that's payee scheme, the Nigerian Tax Administration Act introduced a requirement for employees to file annual tax returns on their total income. Unlike payee returns, which cover only employment income, which returns will capture both employment and non-employment income, this measure will enable tax authorities to effectively assess and tax non-employment income, thereby contributing to increase tax revenue. So you can see that this Nigerian Tax Act is to increase tax revenue, and it will really achieve that objective if it is well implemented or executed. So filing of returns by taxable persons enjoying incentives. The Act provides that all taxable persons enjoying incentives administered by the relevant tax authorities, including incentives provided under of Nigerian Tax Act, shall, in addition to annual tax returns, submit annual tax incentives returns to the relevant tax authority in the form prescribed by the service covering income tax and any incentive other than those which are generally available to all tax payers. So you can see now, it's all about transparency, it's all about accountability, it's all about integrity, openness, and sincerity in ensuring that every taxpayer pay the right tax. Income gains or profit of a resident individual are chargeable in Nigeria wherever they are arise, whether they are brought in or received in Nigeria. So whichever one, brought in from another place, another country, or received in Nigeria, so will be, liable to income tax. Reduction of scope of employment income of non-residents taxable in Nigeria to only those exercised in Nigeria, with exclusions for startups, shared services, technology-driven services, and creative arts. So these are the exclusion of the income tax: the startups, shared service, technology-driven service, and creative art. Remember, we brought you 50 exemption under the Nigerian Tax Reform Act. So this is one of it. Then emolument of a Nigeria on employment performed for a foreign country or international organization that is not subject to tax in any other country under an agreement or diplomatic agreement to which Nigeria is a party will now be taxed in Nigeria. So if they exempt you for paying tax in the country that you are enjoying the income, if you bring it to Nigeria, definitely it will be taxed, and you are living in Nigeria, it will be taxed. So for those that are doing remote work, virtual work, you are earning income from US company that you are working with remotely, Canada, UK, whichever country in the world, and they exempt you from paying tax there, you will be taxed in Nigeria on that income. Tax on individuals employed by Nigeria. Employees of the Nigerian government will now be taxable in Nigeria if they are not subject to tax in any other country, irrespective of exemption under agreement or diplomatic privilege. So employee of the government will also be taxed. Due date for personal income tax return is 31st March, as due date for PIT return has been eliminated. So what we have now before the NTA for next year is that annual return must be filed on or before 31st of the following year, right? So we are intending to identify now the annual returns for employees, right? For payee must be filed next year January on or before 31st of January. And then the entrepreneur, business owners, and all of that, they will file their own tax 31st, that's 90 days after the accounting year end, which is 31st of March. But what we now have in the NTA from next year is that due date is now 31st of March, as due date for PIT return has been eliminated. So the Personal Income Tax Act, this one has been repealed, and we now have the Nigerian Tax Act. So it is 31st of March that we now have going forward from next year. PIT return is now annually, depending on the accounting date chosen by the individual. So the accounting date that is now chosen by individual taxpayer will now determine when it will now be filed. But for the regular accounting year, which is January to December, the due date will now be 31st of March. That is what it implies. So this can be seen in section 13 of NTAA, that's Nigerian Tax are administrative acts. However, due date for payee return remains 31st of January. So for every payee of employees in an organization, is still 31st of January January of the following year. So that's in section 14 of NTTA. So we have illustration on the NTA impact of the low and high income earners in Nigeria. So this is what we have. You can see group A and group B. So if you are earning this is what will be your tax. So this is what we have currently, and this is the A is what we are currently using, while the B is the NTA 2025, which is taking effect from next year. So you can see the difference. This is what the taxpayers are earning. So this is what they are earning. So from what they are earning and what they will be paying. So compute PIT of the above groups individual using PITA and NTA rates and reliefs. So we want to compute based on all these earnings of group A and group B for PITA, which has been repealed, and the NTA, which is now in force from next year. So the group A under personal income tax computation. So you can see what we have here, the PITA and the NTA. So you can see the first one is dash. So you can see the difference. You can see the difference, right? So the implication of this computation is that once your annual income is 20 million and above, you will pay higher tax under the Nigerian Tax Act as compared to PITA. So that is what it is. Look at group B, the personal income tax computation for PITA and for NTA. So remember, PITA has been repealed, so it is NTA we now have that will be in use from next year. So these are the difference of the two acts. So we'll be stopping here in part 5 of this video under this PITA. So until coming on your way in the next part 6 video, please stay compliant. Bye for now.